Americans can rest assured that our banking system is safe.
Silicon Valley Bank has collapsed and federal regulators have taken control.
If we hadn't been driving our economy with easy money and then trying to really quickly undo that, we wouldn't be having these problems now.
We're now facing a world of many potential outcomes.
So the million-dollar question is, how bad is this recession actually going to get? The average person in America is saving only 3.7% of their income, which is roughly a third of our average since 1959, and we're almost at historic lows. And that's all thanks to wages not keeping up with inflation, which has been over 5% for 22 straight months now. And the way Americans are fighting that inflation is by borrowing more money and getting into even deeper debt. And that's also why we have close to $1 trillion worth of credit card debt, and that debt is becoming more expensive.
We've seen this explosion in debt overall. Credit card balances especially have hit a new record at the end of last year, nearly $1 trillion. That's not only the highest ever, according to the Federal Reserve Bank of New York, it was also the biggest yearly increase on record, up $130 billion.
Credit card APRs are hitting almost 20%, which is the highest level since 1985. There's now a huge divergence between credit card debt, which is at an all-time high, and personal savings rates, which are close to all-time lows. And unfortunately, that debt is coming due at a time when interest rates have gone up faster than they ever have before in history. And that's just leading to more debt, less jobs, and more instability in the financial system. So to sum it up, people are making less, they're saving less, so they have to borrow more because they have no choice. And in today's video, I want to help explain exactly what this economy means for the saver, the investor, the middle class, and how bad this recession might potentially get. So with that said, let's get into it. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for a quick update on the economy. So there's some good news, some bad news, and then we'll finish the video with some good news because I want us to feel good at the end of the video. The good news is, so far when it comes to a recession, we're not in one as defined by two negative quarter GDPs back to back, but the odds of a recession are going up and the evidence is practically everywhere. For example, we added 236,000 jobs to the economy, and even though the unemployment rate went down from 3.6% in February to 3.5% in March, the rate of jobs is actually slowing down. As of the latest report from the Labor Department, there were 700,000 less job openings from 10.6 million down to 9.9 million, and the good news here is that there's still about 1.7 job openings for every worker in the US. What's interesting is that data shows incomes are coming up, but when you add inflation into the data, incomes are actually coming down. Incomes were up 4.2%, but the consumer price index, which is what economists use to measure inflation, was up 6%. Now, as interest rates go up to fight that 6% inflation to bring it down to the Fed's goal of 2%, some jobs will be more at risk than others. Tech, for example, was the first to go, but now we're seeing that it's affecting other jobs as well. And it's mostly affecting retail, construction, and manufacturing. But even a company like McDonald's, which is a consumer staples company, which should be less prone to business cycles, is also starting to cut back. Now, most of those cutbacks were on the corporate side, but still, since October of last year, 760 companies have cut 538,000 jobs, and a huge chunk of that, 240,000, were cut from just 20 companies alone. Companies like UBS, Credit Suisse, Amazon, and Meta. So there's no question the economy is definitely slowing down based on all the data, and the Fed is finally getting what it wanted. But the question is, what would happen to the middle class, and what are the odds of a recession? According to statistics, by 2024, the odds of a recession are over 50%, so a little worse than the odds of a coin flip. So you can take a coin, flip it in the air, call it heads or tails, and your odds are slightly worse than that. But the way economists know this is because they look at something called the inverted treasury yield curve, and that has reliably and accurately predicted all 10 of the last recessions since 1955, which also was the year that Doc Brown invented the flux capacitor, so Back to the Future was definitely onto something. Now, you've probably heard of the inverted yield curve from last year, but if you haven't, here it is. And all it's doing is looking at the interest rate on long-term bonds, specifically the 10-year Treasury bond, and measures it against the 2-year Treasury bond. Now, I realize that didn't help explain it, so here's how you can think about it. When investors buy their bonds, the longer it takes for those bonds to return our money, the more money we expect to make from them. And that makes sense because of opportunity cost. It's the same reason if you wanted to borrow my money for 10 years, I would charge you a higher interest rate than if you wanted to borrow my money for only 2 years because I'm taking on a bigger risk. That's how it works in a healthy economy. But when the economy flips and we have high interest rates, if those high interest rates are hurting the economy, which is absolutely what they're doing, they're hurting the middle class and our jobs, That means people are starting to expect the Fed to lower rates to stimulate the economy once again. And historically speaking, that's been a very bad sign for the economy. And right now, the inverted yield curve is so deeply inverted that we haven't seen it like this since the 1980s. And if you look across this timeline, you'll see that every single time this line has dipped below the zero trend, we got a recession shortly after. Even if the line came up, it didn't matter. In other words, even when that yield curve started to correct, it still didn't stop a recession from actually happening. Now, if a recession were to happen, here's what would happen in the short term. Inflation would stay high, if not go even higher. And that's because OPEC just recently announced they're cutting oil production, and the cost of energy accounts for 7.5% of the overall inflation index. And already, the cost of oil per gallon has gone up 15 cents from the month before, and Americans feel inflation the most at the gas pumps. Lending data also shows that domestic banks are already tightening their lending standards. And that means if you want to get a loan to buy a car or a house, you'll need to have a higher credit score, higher income requirements, and put more money down. When it comes to jobs, we can probably expect more job cuts to spill over into other sectors of the economy, especially if Jerome Powell continues to raise the interest rates. Now, that's all in the short term. In the long term, though, people like Peter Schiff expect this next recession to be even worse than 2008.
You know, the media is reluctant to call this a financial crisis. They keep saying it's a banking crisis. The financial crisis of 2008 was a banking crisis. Nobody wants to say what it is because they don't want to evoke memories and comparisons to 2008. But this is a sequel to 2008, and like all sequels, this one's going to be worse.
Another long-term side effect of the economy right now is that our dollar is getting weaker. All this means is that it's going to be a lot harder for the US to export dollars overseas, because if other countries are trading in their own currencies and they have formed their partnerships, it means less dollars will leave the US, which means we can't print our way out of debt. And that also means more dollars will stay at home, which means more inflation. But arguably, the biggest storm cloud over the economy right now is commercial real estate.
Is real estate the next shoe to drop in the aftermath of what we saw with the banks?
Well, there's a new anxiety tonight surrounding the multi-trillion-dollar commercial real estate industry.
So Moody's analysts find that nearly a third of office buildings in its top 80 metros could be, quote, obsolete.
The experts say that billions of dollars in commercial real estate loans are due this year.
Morgan Stanley thinks prices could fall as much as 40%.
Over the next few years, $1.5 trillion worth of loans will be due before the end of 2025. Now, normally this shouldn't be much of a problem because they can just refinance, but interest rates have more than doubled since then, which means their loans are going to be that much more expensive. Not to mention that most of those loans are owned by the smaller banks. And as we saw this year, those banks are already in trouble, especially if the Fed keeps raising interest rates. Now, commercial real estate is also not even fully occupied. After the pandemic, more and more people chose to work from home, so there's less of a need for commercial real estate. When you combine all of that with stricter lending standards, then you have to ask, who's going to lend to those banks that are potentially going to go insolvent, and what will happen to property values? It's estimated that commercial real estate could fall by as much as 40% thanks to all these factors. Now, before you freak out about some of those predictions, here's what you have to understand about them. Everyone loves to make a good prediction because eventually someone will be right, just like a broken clock is right at least twice a day. But for a prediction to actually have value, it needs to know three things. Number one, it needs to know the what, which everyone seems to know, right? It also needs to know the why by showing data of why that something will happen in the future. And then it needs to know the when by telling us approximately the timeline or what will trigger that event to happen. If you know those three, it'll allow you to do the fourth, which is to bet money and invest it in such a way that you can make a profit. And right now, no one can say they know, and we won't know until that event has actually happened. So that's why I don't make my own predictions and I don't listen to them. Instead, I try to look at data for my own benefit so that if that something were to happen, I don't freak out and I continue investing. And here's what the data shows. Our yield curve inverted in July of 2022, and ever since, it's been going down. The evidence shows a 57% chance that a recession will start on or before late December 2023, and there's more than a 95% chance that it will start on or before late July 2024. So it really does look like a recession is pretty much inevitable by late 2024. But the good news is this. Over the last 7 rate hike cycles, investors that bought US investment-grade bonds made an average 26% in the next 2 years following the last rate hike. So that was directly from a wealth management report by JP Morgan. And what they're telling us is, based on their data, the investors that bought bonds right after the last interest rate increase made a lot of money. The trick, of course, is knowing when that last interest rate hike will take place. And here's how you can figure out how to do that. Using something called the CME Fed Watch tool, you can see there's a 28.8% chance that rates will not go up, and there's a 71.2% chance that it will by 0.25%, which may or may not be their last rate hike on May 3rd. So it looks like the Fed will raise their rates once again next month, only by a little bit, and that might be their last rate hike. Now, I'm not going to try to time the bond market because I don't think I'm smart enough, but I still pay close attention to this CME Fed Watch tool because I think the data is really interesting. So that's the bad news and all the data, and now let me share with you the good news and how I'm investing throughout all this. The good news is that all of this is completely beyond anyone's control. We don't control interest rates or the jobs market or fiscal or monetary policy, but we do control how much we spend and what we spend it on. And the reason this video and the research was useful to me to make is because by understanding this stuff, it allows me to continue investing without actually freaking out. And all of that is completely within my control. Like, for example, I can start tracking my spending and then optimizing it and asking myself, do I really need Amazon Prime and Hulu, Disney, Netflix, Uber Eats? I definitely do, but I can ask myself, do I need it, and cut it out if I don't. I can also shop around for competitive rates from utilities and insurances to save some money. And with the money that I saved, I can build a 3 to 6 month emergency fund in case I get let go from my job. I have a small cushion. And if I don't want to invest in the market, then I can always focus on paying down my high interest rate debt. Then once I'm free from high interest rate debt, I can focus on my 401k employer match because that's free money right there. Then I can invest inside of an HSA, which is a triple tax advantaged account where I can put the money in, deduct it from my income, I can watch it grow tax-free and then withdraw tax-free, and then I can put it into a Roth IRA and max that out, and whatever I have left, I can invest it into anything else I want. But the point is, I would focus on paying myself first because that's how I'd prepare for any economic situation, regardless of how bad it gets. Personally though, I continue investing into the market via the broad market low-cost index funds like VTI or VOO, and I continue adding $100 every single day regardless of what happens to the economy. In the meantime, I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. Don't forget to grab your free stocks, links are down below, and then go track them automatically with the spreadsheet link down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday, Friday, sometimes a Wednesday. See you soon, bye-bye.